Mitch, can you explain puts and calls because I am new at stocks?
Larlee can explain puts and calls. I mean, it's pretty much just a contract saying that you think an asset's going to be at lower prices, right? I mean, and you're going to sell those puts when they hit the strike price. But Larlee will be able to do it while I break the seal. Yeah, you don't have to really get into it. You don't.
Well, no, it's just it would be better like with a freaking whiteboard.
Certainly.
Because options for most people, and T-Bone, I don't know if you're brand new, if you know nothing about options, if you've looked at them a little bit or whatever. It depends where you're at as to how I explain them. And look, guys, in general, a call or put option is simply a legal contract that gives you the option to buy or sell a share at a certain price. So, I don't know. T-Bone, name me a share, a stock, or anybody.
Activision Blizzard, dude.
Yeah, okay. Activision is trading at, let's call it $55. Now, you could go in the market and buy what's called a call option with listen to this, strike price of, let's say, $55. Now, the strike price is the price that, in the case of a call option, that's the price you could buy the stock at any point in time between the time you buy the contract and the time it expires. Now, there's some weekly contracts, there's some monthly contracts, there's some longer dated options that are a two out. So the duration varies. But let's say you buy a contract for Activision that gives you the right to buy the stock at $55 for the next 3 months. As you can see, we have 2 gap downs that we have to make up. Now, you don't see them because I'm on the weekly, but if we went to the daily or lower, you'd see the gap downs. And we also see the potential inverse head and shoulder, whatever. Bullish engulfing daily today. Bullish engulfing here. Many signs. Probably bullish divergence. Yeah. Anyways, so back to options. So if you buy a $55 strike call option at any point in time during the next 3 months, if that's the duration of your contract, you can buy 100 shares for each contract you bought of this stock at $55. It doesn't matter where the stock is during that 3 months. If Activision goes up to $78, the last gap, well, you can still turn around and buy the stock from your broker or whoever sold you the option contract, and then you pay $55 for it, and right away you can turn around on the market and sell it for the market price. Or you can decide to keep it on your books or in your account and have that open profit that you might risk to lose, or you could stand to make more. So that's kind of the gist of it. Now, for that right or that option to buy the share at that price for 3 months, you're going to pay what's called a premium. Now, the premium at this point could be, for example, $2 per contract. Now, because each contract gives you the option to purchase 100 shares, then that means that the contract is actually costing you $200. So $2 of premium per share times 100, $2. And that gives you the right to purchase at $55 for 3 months. Now, if the stock goes nowhere, or if it ends up below $55, what happens to your money? It goes to zero. Your option contract expires worthless, and it's gone. Now, if it doesn't move, or if the contract moves in value, because the value of the contract can also fluctuate, dependent on the stock price move, but sometimes a little bit differently due to other factors. But if it moves in value, or if it stays somewhat valuable, but you can see that the stock is not going to end up above your strike price in the case of a call option, you can go back on the market and sell that call option to someone who's still willing to pay some premium for it. So you don't necessarily have to lose 100%, but if you do keep it until the expiration date and the stock at expiration date is lower or at the same price as your strike price, then the contract expires worthless. Which is why normally if you're going to deal with options, you're going to reduce your trade size or your nominal value of the trade by a lot, because if you lose 100% of the investment. But it can be a way to hedge your portfolio in different ways, or it can be a way to take high reward bets while being willing to lose 100% of a small sum of money, and then stand to maybe double, triple, quadruple your money. Because technically, for example, if you pay $2 for that contract here, that's $200, right? Well, if that gives you the right to buy 100 shares at $55, that's $5,500 that you'd have to shell out if you decide to exercise that contract. And if, for example, it goes and closes that gap at 78, well, that means that you can turn around and sell those 100 shares for, let's say, $700-800. So you made the difference in between those two amounts, which is $3,300 for an initial investment of $200. So you've basically made 10 times your money. And a put option would be the complete opposite. It just gives you the right to sell at a certain price, and if you buy a put, then you'd be hoping or betting on the underlying asset that you're trading the contract on to go down.
It's a lot better than a short too, because there's limited losses, whereas with a short there's unlimited losses, right?
Right, but you have time decay.
True.
Whereas, for example,
Theta,
if you
right?
short what?
Theta, right?
Yeah, I think so. Right. I haven't looked at my Greeks in a while. I'm a bit rusty.
Sorry.
But yeah, so that's the gist of it. Now, you can also, and this normally boggles the mind of most investors, you can also, depending on the type of account and different permissions that you have with your broker, you can borrow contracts from your broker and sell them to someone else. And you would actually be collecting the $200 premium. Now, there's different dynamics that come into play if the trade goes against you, but that can be a way to generate income, like actually money coming into your account instead of you spending money to take positions. And there's a strategy called covered calls, where if you own 100 shares of a certain company, you can write a call option against it to kind of increase the income of that position or return of that position, but it also limits your upside. So I think, like, without getting too complicated, if we're not there at already, that's kind of the basics of it.
Like, but you know, the thing is, once you get to the gist of what the contracts are, you use technical analysis the same way. I mean, like, yeah. You like, hey, now I think we're at a low risk area, so I'm going to take a position at this area. I mean, it's like
the only thing that it adds a little bit more complexity is the time value of things. Because if you think a stock is going to drop or a crypto is going to drop by 50%, you could be right. But if your contract says or allows you to only profit from that if it happens in the next 3 months, and it takes 6 months, then your trade, although you were right in the setup and the direction and the outcome, you may not make any money.
Yeah.
Whereas if you just held a short and you had a target and you just held it until then, or your stop loss,
You'd made money. Yeah.
then whatever happens, happens, right? And it doesn't matter how long it takes to get there. Now, like we looked at RXP earlier or other cycles, there's
RXP.
XRP, there's certain ways to kind of try to figure out how much time things might take to develop. And you might be more aggressive, like you might say, okay, I'm gonna risk more, or I'm gonna stand to make more, and be willing to be a little bit more tight in regards to the timing of things. Or I'm gonna try to set this trade up with the option so that I give myself more time that I think it might take, but it gives me more margin for error. But if I do it this way, I might make a little bit less money, right? Because the further out in time the contract is good for, normally the more you pay in premium. It's a little bit like compare options to life insurance, except it's kind of like you could die next week and come back to life and do it again. And the insurance company, in that case of life insurance or disability insurance or whatever, they would be the same as somebody selling an option contract in the stock market, and the one purchasing the stock option contract would be the same as somebody buying an insurance policy. And that's where options and futures came from. Did you know that the reason we have chicken futures, I think, if I'm not mistaken, is it Ray Dalio that started that? He was hired by McDonald's back in the day when they wanted to introduce chicken McNuggets. And basically, chicken was fluctuating too much in the markets for them to ensure a steady price
T-Bone Lucchese tip
without
$25.
them having
Thanks,
to
I am tiring
change
to
the
invest
price
in myself.
at the
So
restaurant
can
all
you
the
sell a
time
call
because of
before
the
the
input
expiration
cost.
date? And if so,
So
what's
they
the
went
return
to
of
somebody
the
on the
options and
market.
the money hashtag
I don't
chart?
remember who exactly, but it's a legend of the market. And they said, look, we need you to create a futures contract on chicken so that we can hedge our consumption of and our input costs, so that we can make sure that we can offer this product at a consistent price. Weird story.
So in the midst of all this, T-Bone tip 25. He said,
Right.
invest in himself.
Thanks, T-Bone.
He says, can you sell a call before the expiration? Absolutely, of course. When you hit a strike price, the rule is a lot of times when you hit that strike price, you want to be taking, your profit, right? While you got it, while you can. But he says, if so, what is the return if the option is in the money? It all depends, right, on like the strike price and the expiration. Am I wrong here on that, Larlee?
Right. So it's
my
the
God.
initial premium that you put in to buy the option. Now, if you let it exercise, it's exactly what I showed on the screen. You have to take and buy those 100 shares. Now, with a broker, they would do that seamlessly. If you don't have the buying power, you can just tell them, exercise the contract, buy the 100 share, and automatically right away sell them on the market at the market price, and you cash in the difference. Now, the other thing that you can do is, like, the day before, the day of the contract expiration, your contract will have gone up in value, right? If the situation is what we're talking about. So you could just go ahead and sell the contract to somebody else who wants to go through the hooplas of exercising it and whatever.
All right. Well, good options talk. Jeez, man. This is good. Got a lot of people riled up in here.
Somebody asked, where was it? Can you set a stop loss on a stock option? Yes, you can. As you can also set a take price. Same thing. The only thing is it's trickier to figure out because there's not only the intrinsic stock price movement that's taken into account. There's things like the evaporation of time in the contract. There's what we call implied volatility that can go up or down depending on the volatility in the markets.
IB.
Right. And that by itself without the stock price actually even having to move, could move the option price. So if you're trying to figure out like where to put your stop loss and your take profit on an option, it becomes much trickier as to where to put those using TA or just using what you would normally use if you just buy or sell a stock, a crypto, an exchange rate, or whatever you're trading. Hope that helps.